Hello.
Hello.
Yes, sir.
Sir, is this technical support? I wanted to ask a question.
Yes, sir. Tell me.
I wanted to know that the people raising hands, are they, is the raising of hands only visible to the host or also to anybody who's in the panelist?
It is visible to the panelists, but only the monitor.
Only the moderator can allow them to speak.
No, that I know. Like only the
Okay.
host can allow them to speak. I know that. But
Yes.
will the show of hands be visible to the rest of the
Yes, yes.
panelists? That is,
Yes, sir.
if somebody raises hands, it would be visible to the rest of the
Yes,
people. No,
sir.
that is what I'm
Yes, yes, sir.
okay. Please, done.
Okay.
This is me. I have logged in through my phone. I am logging in from my laptop in a minute or two. It is setting up the screen. That is what the WebEx shows. So
Okay.
once that is done, you can transfer me the host right.
The host, right? Yes. And sir,
Huh?
make sure that before starting the meeting, you have to start the recording.
Sure, I'll take care of that.
Okay.
No problem. And do we have to give presenter rights to anybody?
No.
At the
Because
moment, for the timer, probably you will be having the
so
presenter
yes,
rights.
yes.
No?
I'll play at 1 minute countdown. So that's why
Okay.
I need that.
Okay, done. So you already have the presenter rights, no? So
Yes,
I don't
sir.
have to do anything.
No.
Okay, sir, done. Thank you so much for helping me through this. Thank you so much. And okay, done, sorted. Thank you.
Can I unmute and start my speaker? Okay, then start its speaker. Any idea how many, what did we say last time's order book was? Was it 6,000 all inclusive? All inclusive? Still 6,000, no, still is 6,000 all inclusive only. 6,000 or something, I don't know. Next time onwards, we should refer to what stories we. Good afternoon, Mr. Shiva.
Hi, Senthil sir. Good afternoon. We have 4 attendees joined right now.
Okay.
So when we want to go live, please inform our team. We will start recording and we will start our session, sir.
Only 4 are joined.
As of now, 4 are there. 5. Okay, the number is getting increased, sir.
Okay.
So please inform us when we want to go live. Moderator, taker.
So you are not moderator anymore, is it, for this meeting?
Yes, sir. From our since we are having moderator facility, our moderator has joined. Our moderator today's moderator is Samir.
So Samir was there last time also.
Same person. Yeah.
Yeah. Samir, don't, last time, first time, don't.
Yeah. No, we are through, sir. We are through as per our sheet.
Okay.
Samir, you can able to hear me?
Yes, sir, very clearly.
Yeah. Take us, Samir. All the best.
Sure. Hello, sir. Good afternoon. Sir, one thing that I wanted to confirm was last time what we did was whenever we had a question, you answered to the question immediately once the question ended. So, do you want to keep it the way we did it last time, or do you want to have all the questions together and then answer all of them together?
We will go question wise, Samir. What I will do is once you open that thing and you ask the question, I will say thank you for the question and I will do the answer. Then when I finish it, I will say back to you, Samir.
Sure, sir. Done. Noted. Done. Thank you so much.
Samir, it's a earnings call, not the AGM.
I know. Yes, sir.
Yeah.
Yes, sir.
Yeah. That's what.
Okay. Perfect. Done. Technical team, can you assign the host rights to me, please?
And you can do that 60-second thing timer.
Yes, sir. Once you inform us that we are ready.
Please go ahead and start the timer.
Okay, sir.
Start the recording.
The timer has ended. With your permission, can we begin?
Yes, please.
Ladies and gentlemen, good day and welcome to Lakshmi Machine Works Limited Q2 of fiscal year 2022-23 earnings call hosted by NSDR. As a reminder, participants will be in listen-only mode. I just wanted to confirm if my audio is coming through.
Your voice is echoing.
Okay, now is it better?
It's better.
Okay, thank you so much for helping me with that. Okay, so we can begin now. Ladies and gentlemen, good day and welcome to Lakshmi Machine Works Limited Q2 of FY22-23 earnings call hosted by NSDR. As a reminder, participants' line will be in listen-only mode, and there will be an opportunity to ask questions after the brief by company officials. Please note that the call is being recorded. This is Samir from NSDR. We have with us Sri Ventil Sir, Chief Financial Officer, and Mrs. B. Lakshmi, Senior General Manager of the company. Over to you, sir.
Good afternoon, everyone, and thank you for joining Lakshmi Machine Works Limited earnings call for Q2 for FY22-23. We will have a brief about the overall performance of the company for the period ended September 22, followed by an interactive session. To begin with, let me explain about the overall performance of the company for H1. Then we'll proceed with segment performance and then on consolidated performance. The financial results have been already posted on the company website and hope you had the opportunity to go through the same. I am happy to share that the company achieved the turnover of 1,168 crores in Q2, which is 20% higher compared to the Q1 of FY22-23. This milestone was achieved by the company amidst a lot of challenges on exchange rate, logistics, and shortage of parts and mechatronics items and things like as such. The revenue achieved for H1 is rupees 2,140 crores compared to rupees 1,228 crores in H1 of FY21-22, and this is a growth rate of around 74%. During FY22-23, the H1 profits of the company before exceptions and taxes is 222 crores as compared to 80 crores during H1 of FY21-22, and this is a growth of around 176%. Even if we have witnessed a substantial growth in turnover, we have also witnessed a substantial increase in input costs as well. Moving on to segment performance, TMD contributed to 75% of the turnover, MTDA and Foundry to 23%, and ATC to 2% of the turnover. Now for TMD, the market scenario has been quite challenging for the spinning mills, and the capacity utilization has been low over the last 4 months. The yarn demand has also had an impact because of lesser exports and also the demand going down. So nonetheless, it has been a very, very challenging situation for all our customers, which we currently face. However, we have been able to achieve this turnover because we have been able to ship out for the projects which have already been in place, where the funding for the customer, everything has been in place, and these are the orders which we continue to ship out. So revenue for H1 for TMD stands at 1,700 crores as against a revenue of 902 crores for H1 of FY21-22, and there's a growth of 88%. The profit for TMD is at 162 crores during H1 of FY22-23 as against 25 crores of H1 of FY21-22. And this is quite a substantial growth of close to 500%. The increase in turnover is based on incrementally pushing for higher output from the existing machinery and bringing in balancing equipment and thereby trying to increase our turnovers. So we have been able to continuously increase our turnover quarter on quarter and thereby trying to meet the order books and try to reduce the timeline for the orders. With respect to the order book, we still have an execution time of close to 12 to 18 months, depending on the various types of machines. We are also happy to note that there has been an order inflow, which is similar to the amount of shipments what we have done. So our domestic order book still stands at close to 6,000 crores. And for exports, we have close to 600 crores of LCs on hand. With respect to market share, on an overall market share, we are close to around 70%. And whilst we get into the questions, we can give details of it later on. With respect to the performance of our subsidiaries, we are very happy to note that LMW Textile Machinery Suzhou Company Limited, that is the Chinese subsidiary, has clocked a turnover of 146 crores for H1 of FY22-23, as against 81 crores in H1 of FY21-22. The profits stand at 17.32 crores for the first H1 FY22-23, as against 3.62 crores for the same period last year. As you are aware that we had started our operations in Middle East, and it is LMW Middle East. So we have been able to clock a turnover of 19 crores for H1 of FY22-23. However, because of the initial setup cost, there is a loss of around 1.6 crores for the same period. We are currently manufacturing, rather assembling the preparatory machines in UAE for the last 6 months. Now I go to MTD. Revenue for MTD stands at 495 crores for H1 of FY22-23, as against 348 crores for the similar quarter previous year, which shows a growth of around 42%. The profits for H1 of current year stands at 31 crores, as against 32 crores for the same period of last year. But there has been a slight decline of 3%. The impact of this 3% can be explained is because of the higher input material cost, higher cost of input material, especially the forex having depreciated, around a few of the reasons as to why we have been able to only maintain a flat line in our profitability as far as this division is concerned. With respect to the order book, we have been able to maintain a similar 1.5 months of order book for this division. With respect to the auto and non-auto segment contributes to 55% and auto segment contributes to 45% in this particular division. Now for ATC, the revenue in ATC is 53.22 crores as against 17.35 crores in H1 of FY21-22. The profit stands at 1.71 crores for the current year, as against a loss of 12.8 crores for the similar period last year. We note, it is important that we note that the order pull has started in this vertical. Hence, we see a higher turnover. And we have also used the time when there was no turnover, we have used the time to manufacture and keep. And when the pull has come, we have been able to deliver, thereby showing a fairly considerable turnover for the current quarter. And we are now ensuring that we try to keep the run rate similar to what we've seen, and thereby trying to make it a break even and also start earning profitability, to bring back profitability into this particular vertical. I think this is the brief I would like to start with. Now back to the moderator, and we can start Q&A from here on.
Thank you so much, sir. We can continue with the interactive session. I would request the attendees to please raise hands if you would like to ask a question after the communication of your name and unmute status. The first person who we have is Mr. Dhaval. Mr. Dhaval, and if possible, you turn on. Mr. Dhaval, you have been unmuted. Mr. Double, if you could hear us. Mr. Double, we can see you. Sir, we still cannot hear you. I believe you're trying with the earphones plugged in. Is it possible to pull the earphone out and have your question?
Hello.
Yes, sir, we can hear you now.
Yeah, great. Okay. Hello, sir. Thank you for the opportunity. The first question is on the order book. So last quarter, we did a call in August. We were at around 7,000 crores, and now we are roughly near there in terms of the order book. If you could, elaborate how do you see the future or the near-term order visibility for the textile machine division, given the weak period the industry is going through right now. That's my first question. My second question is on the machine tool division. So there, we are increasing our share of non-auto. And if we were to, take a 3 to 4 year view on this business, where do we see this business growing to? And also elaborate on the products. How do we increase the wallet share of the customer? Which are the products we are doing in this division? And my third question is on the advanced ATC business. As you mentioned, the order pool has started, and we also see we are forming a new subsidiary where we are investing 50 crores for the working capital requirement. So even on this side, if you could elaborate, more on the customer side, what kind of work are we doing? I understand we have been working on this division since a very long time, and now we are seeing a very good traction. There also, if you can talk about the product, the customer, what sort of arrangement you have? Are you a tier 1 supplier or a tier 2 supplier there? And the future for this business. So yeah, these are my questions, to start with.
Thank you so much, sir. Thank you.
Thank you, Mr. Shah.
Yeah.
So with respect to the order book, you are absolutely right. We have close to around 6,500 odd crores of order book. And we have seen that the first half, we have seen a similar order flow coming in, right, in terms of domestic. Of course, the market is not really supporting it. It is going through a tremendous challenge. And we are able to observe it with the fact that there's a lot of components. See, the capacity utilization is reduced, but still people would like to invest, because what we are seeing, what we have and what we're seeing is the fact that all the levers which the government has given, be it in terms of RODEP, be it in terms of PLI schemes, be it in terms of all the schemes for the supporting the China plus one factor, what they call it, all that is in place. So definitely the outlook is that longer term, this would pay out. And our investments, when the customer invests, we are not investing for short term. These are all projects which have 15, 20-year life. So people are still taking the call to go ahead and put up the projects and pay us for the orders and book orders with us. I think the people who are taking long-term call are continuing to do it. Yes, we have seen there are some short-term challenges where people who are individually upgrading some or modernizing their mills, they tend to postpone. But even during this time, we should understand that people are, when they stop the equipment, also they are maintaining those equipments, right? So a lot of things are going on. So this is a long-term play. So the order flow still is there. This is as far as domestic is concerned. As far as export is concerned, we are seeing similar things happening in other countries where the spinning is coming into the country. Let us take example of Bangladesh, and it is done quite well. similar to how India has benefited, Bangladesh has also benefited. Turkey has benefited to some extent. Of course, Turkey, we have its own challenges in terms of currency, inflation, etc. But we are also seeing that a lot of things have gone into Turkey because of this +1 factor. So yes, so we are seeing this order inflow. And if you are looking at, okay, what is the type of order inflow that's happening? We are still seeing mostly 60% cotton, 40% synthetic, that kind of a flow. Again, across the border, across the country, it is just not north, west, south, or something like that. It is across the country. This type of orders are coming from. And as you know, recently the Jammu and Kashmir they've given a special incentive scheme in J&K to set up textile mills. So I think the mills are, at least the promoters of the mills are taking advantage of the current situation, which is, we should say from the support side, it has been the best. So that is how we see it, and we hope that over the period of next few months, there will be a demand. Because of geopolitics, the demand has come down. We know that Europe is in a very tough situation where the energy costs have shot up so high. We are talking as high as even for household, the energy costs have shot up by 400%. Technically, US is looking good, but there are some challenges there. So we do see this as a challenging period, but definitely we'll come out of it. And that's where all our customers are doing the long planning, and that is the reflection of the order book. Now, with respect to the machine tool division, since it's a little bit of a broader question which you have asked, so let me try and answer this. So we are basically into 3 types of machines, what we call turning centers, which is basically the lathes, and we have vertical machine centers, and we have horizontal machine centers. We have close to a 22% to 25% market share in the turning centers, and we have a single-digit market share close to around 7% or so on the machine centers. So we see that, and the non-auto sector definitely is on the growth trajectory, and we have been introducing quite a lot of machines towards the non-auto sector over the last couple of years. And we have also been very clear in terms of investment into this business, because we are, if you were to ask me the numbers, what we see today are perhaps close to around 60-65% of capacity utilization as far as machine tool division is concerned, because we have got enough capacities there to deliver more. So the product portfolio is to support auto sector. In non-auto sector, we have general engineering, pump and valve, die and mold. So at least we split it up into close to 25 odd sectors, where these we have different models to cater to different sectors. Whilst we don't give out any specific numbers saying that this is what we would be doing, we definitely, like I said, you can take away from the fact that we are only at 60% capacity. We have enough capacities to grow in this particular segment of MTD. But the challenges on the MTD is only the fact that it is predominantly imported material, so there is always a challenge for MTD. Whenever there's a foreign currency depreciation, there's a direct impact onto this MTD business. But yes, this is a growth area, a very large market available, and we are the price leaders here. Our machines are more expensive than the 4 or 5 competition which is out there in India. But at the same time, the high spec and high quality machines are delivered out of this particular machine shop, the machine tool division. And now let me cover the ATC division. Yes, we have been in this particular business for quite some time now. It's close to a decade or a little bit more. We have the order book in these divisions are quite strong, but as we had seen during the time of pandemic and post-pandemic, if there is no pull, there is no value for the order book. So we have seen that we have considerable losses. In fact, last year, and we have taken drastic action to try and resize the business so that we can start delivering when the orders start picking up, and we have seen it happening in the first 6 months. The order book for this business over the next 5 years, because these are all orders which are given out to us for what we call long-term executions. So over the next 5 years, we have got close to 400 crores of order book for this particular division. But again, everything depends on the pull. Now, to give you a slight understanding on this division is divided into two aspects. One aspect is metallics aspect, where we effectively do machining and we supply components right from a small component up to a 10-meter wing component. So we make various components for the customers. We can't give you customer names, so we can only tell you what type of components. So again, we make components for engine parts, we make components for commercial, we make components for defense. And the other part of it is what we call the composite business. Now, composite business is around 3 years old. We had set it up during the time of COVID. The idea here is to work for space and space-related agencies, and predominantly this was meant when we established for Indian space business. However, we do find that because of, again, back to COVID, there are a lot of challenges in the way placement of orders and pull-offs were very, very slow. So we have now started venturing into the private to supply to OEMs and other companies as well. With respect to the context in which we are doing a demerger of this and making it onto 100% subsidiary of LMW, this business comes with its own risks, and the idea is to ring fence this at the same time to grow the business. So an example of this would be the fact that any part we supply, if it is going to be an engine part, you will have to support till the last few aircrafts are in the air. And there are a lot of follow-on risk which comes with this kind of a business. So we had taken a decision a year and a half back to kind of demerge it, ring fence it. At the same time, it also gives us flexibility to tie up, which is very critical in this business because it's mainly a build-to-print business. So all we're doing is execution of someone's design at the moment, wherein by doing that we'll be able to grow to level 1, level 2. And as of now, you asked whether we are tier 1. No, we are not tier 1. We supply to tier 1 suppliers only. We don't make any component or sub-assembled for it to be supplied directly to a customer at the moment. I think this kind of covers all the aspects of your question. Now back to you, Mr. Samir.
Thank you so much, sir. Thank you for answering all the questions. For the people whose questions have been answered, they can raise their hands. Going ahead with the next person with the next question amongst the attendees, we have Mr. Ritvik Sheth. Mr. Ritvik, we have you unmuted.
Yeah. Hi. Can you hear me, sir?
I can
very
hear
clearly.
you. I can hear
Yeah.
you, Mr. Ritvik.
Yeah. Hello,
Thank
hello,
you.
sir. Best wishes for the festive season to the entire LMW family.
Thank you so much, and thanks for joining the call. Thank you,
Yeah.
and wish you and your family the same. Yeah, please.
Thank
carry on.
Yeah. So I have two questions. Firstly, on the gross margin, with falling raw material prices, one would have expected at least some improvement in margins. So, can you throw some color? You mentioned that FX has been a dampener for us, but can you mention, what would be the gross margins outlook for the next 2 to 4 quarters, given the current raw material price, especially steel, aluminum? And should I ask the second question now or after?
Yeah, please go on, Mr.
Yeah.
Ritvik.
Yeah. And my second question is, I believe we have spent about 165, 170 crores on capex in the first half. So if you can throw some light on where it has been spent to build up the capacity and what can be the incremental turnover from the same, then it would be very helpful for us.
Okay. Anything else?
No, sir. As of now, that's it.
Okay. I think let me take the capex question first. For the capex, what we have spent on is we have been spending on the balancing machines for TMD and MTD, and that is where we see the incremental turnover. In fact, we have taken up every quarter on quarter, we discuss the same thing, to actually say that our effort in the company is to get more out of the existing machines, and there's a lot of work which goes into doing that. So whilst we are not going ahead, I'm talking about morely on TMD side. Let me come to MTD side separately. So as far as TMD is concerned, it is more of balancing machines. MTD side is basically, like I already mentioned, there is a capacity. We are adding capacities there. We are building up the capacities because we feel that that is something where, as we introduce more machines, more models, especially for the auto or non-auto segment, I think we require higher capacity. So as we speak, we are putting up more infrastructure as far as MTD is concerned. I should also say that for the amount what you have seen there, we have upgraded our 15-year-old aircraft from turboprop to a second-hand jet. The cost of this, inclusive of tax and everything, comes to around 110 crores. We have been having business aircrafts for over 3 decades, and we continue to maintain this for our business travel. And as you can see, our business range has increased. Our exports have gone up. Our internal movements have gone up. So this basically goes towards helping the travel, what we have already planned. Now, coming back to the margins, I think it's a very good question, and I think it's very important also to understand. Like, if you actually see between last 2 quarters when the turnover has kind of gone up, the COGS has stayed similar. There are a couple of reasons there. See, the steel price definitely has come down, and it has supported us. But what has happened is that the transport costs and the mechatronics costs have not come down. So if I were to share, see, today with the cost increases, we got a fairly heavy supply chain which comes out of Europe. So today for all the electronics or mechatronics parts, if you see, the energy costs in Europe has gone so high. And in fact, we are now pushing all our suppliers to deliver. It is no more than the cost we are pushing for delivery, because even in India we are pushing more machines out. We don't want any issues on supply chain. So things have actually become more expensive post February 2022, and it has not gone down except for the steel. So now looking at 2 more aspects which is affecting the overall margin. Like I said, the spinning has not been very capacity intensive, utilization center. So that has resulted in a slight change in the mix of our OEM and spares. Whilst we have in the past seen a very standard mix of 50-25, that's 50% domestic, 25% exports, and 25% spares. This time we see almost 7 to 8% fall in the spares, which is resulting in our COGS maintaining the same percentage. So that is one reason. So you got one reason because of the mix change and one reason because of the cost, which has kind of increased. Now, all our machines are going at the revised price. The last price revision, as you know, was done in the month of December 21, and subsequently there has been no price revisions on our OEM machines, and so the costs have not actually significantly come down. So we are working towards ensuring that we are able to reduce our COGS as we speak. So from TMD's perspective, and if you were to see now, get into the segmental results, we have been able to see, I think, around 1.5-2% increase in the margins quarter on quarter. For that is something which we hope to make it a little bit better. I mean, that is the effort what we have taken. we are putting a lot of efforts on the cost saving side because having done 2 price increases over last 1.5 years, I think the work is towards making it better. So yes, I think this is as far as textile machinery division is concerned. With respect to machine tool division, where almost 60% of my cost of goods are imported, Forex has had definitely a significant impact as far as machine tool division's margins are concerned. And that we are again able to see with the flatline margin growth. Even with the turnover growth, it has been a flatline margin growth. That is one reason. The second thing is the fact that the non-auto segment consumes more of vertical machining centers, and vertical machining centers have a slightly different margins compared to our turning centers. So that is the trade-off. So there is definitely a cost impact. Now, looking forward, I mean, very difficult to say where we are heading in terms of cost. Like I said, we are still pushing towards more supply rather than the cost as far as our purchases are concerned. We hope that we are able to come out by February, March, because I think the thing to look out for is how difficult the winter is going to be in Europe. And that is going to set the trend both for the cost and the availability of material. So we are quite vigorously and aggressively working towards ensuring that next 4 to 5 months we are able to have material on demand and so that our supplies continue. So if it means that we have to got to pay more, I think we have got to pay more to get the material in. I think that is the way we are looking at the current scenario. I hope this answers the question. Thank you. Back to you, Mr. Samir, and we go to the next person now.
Thank you so much, sir. The next person who has raised his hand for the question amongst the attendees, we have Mr. Manish Goyal. Mr. Manish, can we have your question with the video turned on? You are audible.
Yeah, thank you so much.
Good afternoon, Mr. Manish. How are you?
Good afternoon. Not sure if the video is on, so.
Not able to hear.
Just 1 second.
That's fine, Mr. Manish.
Yeah. Hello, sir. So just couple of. So if you can just give us a revenue breakup for TMD between, say, domestic exports and spares. What is it currently, and how was it in, say, Q2 last year? Just to get a sense how the revenue mix has changed for the TMD. Number one. Number two, on the margin side also, like last call, we were expecting that Q2 may see better improvement, and probably there was an indication of 2% increase. And especially in machine tool division, we had taken a price hike as well. So it's still not getting reflected on the margins. You did mention a couple of reasons in terms of high forex impact. But just wanted to get a better sense, how do we see it going forward? And third question, sir, on other income is quite high in this quarter. So if you can explain that, and maybe also what we see in TMD division also, the profits are probably, is it also partly due to certain other operating income or other income which is always clubbed in the segment profits? So if you can clarify that as well. Thank you.
Yeah. Okay. First thing is on the revenue breakup. What we see is it is around 61-62% of domestic, around 22% of exports, and the balance basically is 61 from 16% of spares. That is the current trend which has happened for last 6 months. Then that is reflective of the fact that the spinning mills the utilization has been low this space, so by logic, the spares consumption have all kind of petered down. And whilst normally what you would see is always 50% of domestic machines, 25% of exports, OEM, and 25% of spares. I mean, that is the general trend what we have, and that has changed in the last 6 months, and that is one main reason for the margins not to reflect that. You're absolutely right. All our new prices have been effective, and we did anticipate 2% or 1.75 to 2% increase in profit, but that has been taken off because of this mix which has changed. Now, with respect to the TMD has also benefited from the fact that the forex has depreciated, while MTD has taken the brunt of it. TMD has taken the benefit of it. So, addressing your question on other income, close to around 18 odd crores is forex income, and the balance is basically interest. Now, nowadays we are getting a better bank interest compared to the last year where it was 5.75 and things like that. Now we are getting close to 6.75, 1.2% higher bank interest we are able to get, and the other income is basically made up only of these two and nothing else. With respect to the margin improvements on TMD and MTD both, we are now working on a specific, very specifically towards reducing the costs. I mean, that is what we can think of doing in the current situation, where we have been able to put a lot of effort, and our SCM and R&D, everyone is trying to put a lot of effort into this cost and cost reduction exercise. But there are certain things which we are not able to have control of because of all external factors. With respect to machine tool division, our machine tool, yes, we did a price hike in the month of May 2022 for MTD. Everything is in new prices, especially in the current quarter. But the forex impact has kind of taken away the entire benefit what we were anticipating to come. I think perhaps in last quarter, the currency has moved on by 4 to 5 rupees, and that has taken off the margin what we could have seen in MTD. I think that's what is sum and substance as far as reason for MTD's cost increases. I mean, flatline margins are concerned. Back to you, Mr. Samir.
So thank you so much for answering the questions. We would once again like to request to all the attendees that we have here, if you have any questions, we can have your questions taken up after you raise your hands. Sir, so far we had 3 of the questions by 3 people in the attendee list who raised their hands. We see no further people at the moment.
Yeah.
Sir, yeah, exactly. We have Mr. Vishal who just raised his hand for the question. Mr. Vishal, you have been unmuted. If possible, we can have your video turned on for the question.
Hello.
Good afternoon.
Hello. Good afternoon, Senator sir. Thank you very much for this opportunity. So my question pertains to the machine tool division. I think we've been doing very well there, and the demand continues to grow substantially because of various schemes on the manufacturing side. So how is the competition shaping up here? We've seen that many people have also come up. Many of the competitors are also expanding their plants. So could you elaborate a bit more with some details on the competitive side, competitive intensity here? Thank you.
I think I should say great question, because it is rather large. You are absolutely right. Most of the PLI schemes, if you think of, is to support the manufacturing side, and We also are of the opinion that it is going to actually expand quite substantially, and we have over a period of last 3 years, I should say 3 to 4 years, in fact, a year and a half even before COVID, we have started expanding the footprint of this particular business. Now, this business does not require a lot of manufacturing capacity. What it requires is a lot of assembly capacity. So what is required is more and more assembly space, because many components are bought-out components. Of course, we manufacture our own, we have our own foundry, we manufacture, we pour, we melt, pour, and machine our own castings which go into this. But if you were to look at the mechatronics part, if you were to look at the critical technological parts, and they're all imported. So what this business requires is assembly. So yes, you're absolutely right. I think the competition is, everyone in this business is expanding their footprint in terms of expanding their floor space and expanding their factory space, which we are also doing. Now, there are a handful of competitors in this particular area, and we have to differentiate ourselves with only the best quality product, and that is the main thing in this particular business. Quality, reliability, and the cost. When I say cost, it's cost of producing the final product, right? So these are the 3 things we are trying to differentiate ourselves with. And like I mentioned, and I would like to repeat that in terms of turning centers, we are market leaders as far as turning centers are concerned. But machining centers, which are called vertical machining centers, of course, we are not the market leaders. We've got competition which is it's doing quite well in terms of market share. So our hands are full with what we have a clear-cut target. We have a clear-cut plan to expand our number of machines what we supply, and we are working towards that. And it is a very, very, very competitive business, because your average, the buyers of this machine, if you again see, almost 60% of the business, or 60, I would say even 65% of the business goes to people having an average of 2 to 4 machines. So it is a very price-sensitive market, but there's a very large market here. I mean, so that is the way we see that you expand, you compete on the 3 things what I already said, and try to get as much market share as possible. At the same time, leveraging the fact that India is becoming 100%, it is becoming an alternate source of manufacturing, place of manufacturing, and we are there to make the best use of this. And it's a business which can definitely grow leaps and bounds as far as we are concerned. Thank you. Back to you, Mr. Sunil.
Okay.
Thank you so much,
Just
sir.
one follow-up.
Sorry, please.
Okay, thank you.
Please,
Okay. Sir, what is the growth target for MTD for the next few years? What's the growth rate that you are looking at?
See, you have seen what we have grown. So we are sorry, we don't give out specific numbers for the future.
Yes, sir. Yes, sir.
Yeah.
So, but some rough cut idea.
But like I said, already I mentioned that whatever numbers we see, we still feel that there's a 60% only. We have our capacity utilization at 60%. So like I said, the idea in this entire business is the fact that you keep building capacities, and so that you are able to deliver more. It's an assembly business, more of an assembly business, a high quality assembly line. So that's how it should go.
This market for the machine tools business, the CNC machines, the market would be growing at what rate, sir? Could you give some perspective there for the industry as a whole?
Very difficult. See, there are multiple types of machines, and we are only
Yes.
in machining centers, right? Without grinding machines, we are not there in grinding machines.
Yeah.
So very, very difficult to give you for the overall perspective of
So
the market.
if you just take the turning machines, for the turning machines as a whole, the market would be growing at what rate? Would it be fair to assume that 12 to 15%? Would that be the right way to look at it?
Yes, I think depending on this, yes, definitely. I think 10% to 13% I think is taken. Especially with the new manufacturing coming up for EVs and all, the turning centers are the equipment which are required. Definitely, I think 10 to 15% is, I would say, possible, easily possible.
Okay, okay. And then, so with this expansion of the assembly shop for the machines, are we also adding new products?
Of course. See, this entire
Or new subcategories? Sorry.
I mean, I just mentioned that there are various type of categories for now. If you were to take non-auto sector, we are talking about, like I said, die and mold, general engineering, pump and valve. There are close to 25 categories which we categorize these machines into.
Okay.
And we have to see these machines are fairly specific because it is defined by what we call a table size, right? So, but if I'm making a table size of 1.2 meter, it's not going to fit. It has no requirement for some types of industries. Die and mold has plastic. For example, die and mold has got a specific table size requirements. I have to make machines for the particular table size. So that is the way we have to. You're absolutely right, and the way we grow the business is to look and try to build machines, design machines, and build machines for a particular segment. That's the way we do it. Okay. Mr. Samir, back to you.
Thank you so much, sir. Thank you. Going ahead with the next person with the question, we have Mr. Mayur Parkiria. Mr. Mayur, you have been unmuted. Can we have your question with the video turned on if possible?
Yeah, I'll. Am I visible and audible?
Yes, Mr. Mayur, you are.
Yeah. So due to bandwidth, please allow me to switch off the video again because.
Absolutely. Please, at your comfort. Yeah.
Yeah. So sir, I joined the call a little 15 minutes late, so I don't know if you answered this, so it may be a duplication. Sorry for that. I am sure it was a basic question, so somebody would have asked, but I missed it. So have you, what is the outlook for TMD division in the light of challenges which are going on? Do we expect the same run rate to continue for this year, and how do we see FY24 qualitatively, and some aspect in quantitative? So that was my question, sir.
Okay. With the run rate, we definitely spoke about the challenges, what the industry is facing when you are not there. So definitely we find that there are a lot of things which are going on in terms of price, in terms of demand pickup and things like that. But however, the order book today we have, our sales team is doing a lot of work to ensure that we keep the same run rate, and we will definitely see the same run rate going for the next quarters as well. The challenges for us are twofold. One is to ensure that we are able to push as many machines out as possible and to keep the supply chain up and running at the same time because of all the challenges on the supply chain with the energy cost, everything which we see in Europe, where some of our supply chain is based out of. So the answer is yes, we will see a similar run rate, but it is not happening just like that. There's a lot of work which is going behind this to ensure that we are able to push this out, and at the same time working with all our customers to ensure that the deliveries are being taken. And that's the way we are looking at over the next 2 quarters. And 23, 24, I mean, we don't again project anything, we can't give you anything, but we did mention the meeting that the order inflow has been almost similar to what we have seen in terms of order execution. So we are still having the 12 to 18 month delivery, and that's the way we see it going forward as well. Thank you. Back to you, Mr. Samir.
Thank you so much for answering to that, sir. Our next person who had his hand raised was Mr. Dixit, but he just lowered his hand. Mr. Dixit, would you still like to go ahead with the question?
Dixit just lowered his hand. Okay, he has his hand up again. Mr. Dixit.
Yeah. Yes, sir. My questions had been answered, so that's why I lowered my hand. Yeah, thank you, sir. Yeah.
Okay, thank you so much, sir. Thank you.
Thank
So if at
you.
all we have anybody whose question hasn't been taken up yet and would be interested in asking a question, we can have your hand raised. To all of the people in the attendees. Sir, I believe we do not have any further questions at the moment.
Okay. Thank you everyone for joining the call. Please note that the information contained in the earnings call for Q2 of FY22-23, the information provided in the call is not intended nor may be considered as an offer or solicitation for purchase or disposal or trading or any transaction in company shares. Back to you, Mr. Samir.
Thank you so much, sir. With your permission, we would like to conclude this meeting.
Thank you. Thank you, everyone. Thank you. And once again, happy Diwali to everyone. Thank you.
Thank you so much, everybody, for the questions. Thank you so much, Senthil sir, for answering to all of the questions. And greetings for the festival to everybody. Thank you so much for joining.